Okay, the last one we are going to talk, one very interesting pair is called Aussie Dollar. And also we think this this currency might have lots of potential to move lower. So historical, there's three things actually might affect this currency. First is the RBA policy. And number two is the China policy, China economics. Number three is the global economy sentiment. So let's talk about the first one, the RBA, Australian Central Banks. So a few weeks ago, actually, we hear about the RBNZ. They're going to say that they're going to cutting the interest rate because they think the global growth is going to affect its economy. So according to historical basis, these two central banks, RBA and the RBNZ, their movement is a bit going into the same tandem. If the RBNZ is going to talk about, they're going to cutting the interest rate, or at least it is in its considerations, most likely the RBA will follow the suit. So we expect actually in the coming a few quarters, the RBA probably will continue or even become more dovish on its monetary policy. It's something like we need a weaker currencies on a basket basis. Also, we need a lower interest rate to support our business. So if this is the case, we believe Aussie might have further room to go lower. And second, we are going to talk about the global capital market. So of course, we believe that in the second quarter compared to past 3 quarters, risk off probably is one of the main theme in the capital market. So if there's a risk off is a main thing, most likely the Aussie and the Kiwi will underperform the rest of the currencies because these two currencies are considered as the risk currencies. Number three, I think the most important thing is we're going to talk about how the China markets and how the China policy to affect the Aussie. As we all know that Australia exports lots of iron ore and raw material to China, so demand in China actually have a very large, substantial influence on the Aussie dollar. So if we look at the Shanghai Composite Index and the Aussie dollar, their correlation actually in the past 5 years hits about 70 to 80%. So that's pretty high. So if we think the Aussie dollar might go low, then most likely Shanghai Composite Index might also stay low. So during the government meeting in March this year, Premier Li Keqiang, which is the China PM, he mentioned that he's going to give more support to the private companies. So these private companies, lots of are not listed companies. So their borrowing cost is pretty depends on where the 10-year bond yield standing at. So if the China stocks keep going higher and higher, go to a crazy bull market, the bond yield might also go higher because people are more willing to buy the risky assets and avoid the safe haven assets like China bond yield. If that is the case, that actually go against the government objective that they want to lower the interest rate for the private companies. And the second is the government till now still want to use the prudent and target monetary policy to support the economy. So without a broad-based monetary policy easing, it's very difficult actually for the current Chinese stocks market experiencing a slower growth rate to extend its bull. We think this kind of possibility is kind of low. So if the China stocks is going to surrender or retreat at some certain point of time, some market people think it will start to retreat if the price at 3.2. Now it's not so far from this level. Then a retreat in Shanghai stocks market is still going to support the Aussie dollar. So a global slowdown, a China slowdown, and a more dovish RBA, and also the global stocks market seems like not so outperformed compared to the past few years. All this probably will send the Aussie in second quarter somewhere to 0.7.